Comparing yield and capital growth is one I've wanted to figure out myself for a while, I guess. So what I mean by that, yes, everyone knows what yield does and what capital growth does, but my issue has always been that there's a very big focus online where capital growth is king. How much is this suburb going to grow over the next 5 years? What's this going to grow? And there's very little on yield. And things I wanted to figure out is you'll see these properties that are at, 10% yield, for example. Now, if I was certain or confident that that property wasn't going to go down in value, can I just buy that property? Do I need to worry about this 6-7% capital growth in a capital city? Or can I just take the confirmed rental income and will I end up better off for it? And more so than that, I wanted to actually quantify it because, again, it's very easy to sell capital growth, which I'm going to do to you shortly. It's easy to convince someone or show someone why capital growth is better than rental income, but in what capacity? Is 10% yield better than 5% capital growth? That's questionable. 5% yield versus capital growth, yes, the capital growth is better, but there has to be somewhere in the middle where you can figure out what's actually going to grow you more wealth. There's a calculator on the website, so I'll go through that later. That's where I've got a lot of my figures from. But we'll really go through and justify everything as best we can. We'll start off fairly simple, and by the end of it, we're going to get very complicated. So what you're looking at on the screen, it's I guess a bit of an example of where we are going. I have really tried hard to, as I said, quantify this and do it as accurately as I can. Obviously, we're never going to get a perfect result here, but I wanted to at least make some benchmarks or estimates that people can use as a starting point. And if you look down the bottom left here, you got, what is the value of 1% capital growth, and depending on the time frame, tax bracket, I have actually come out with a figure there. Whether it's right or wrong, you can decide yourself based on the assumptions I'll show you, but we've at least got somewhere. First thing, I'm going to sell you capital growth. I will show you, and I don't really watch a lot of the online stuff, to be completely honest with you, but I expect this is how most of the people online will sell you on capital growth and convince you that it is clearly superior. Maybe they are right. So, firstly, capital growth. We've got a property here on our screen of 500,000. Now, this property, if we apply 10% capital growth to that, we're going to gain 50,000. Now, when I say gain 50,000, it means the property is now worth 550. We've not got the cash in the bank or anything like that. But the benefit of capital growth is that we don't have to pay tax on that because it's an unrealized capital gain. We haven't sold the property, which means if you apply another 10% on that the year after, then you'll gain 50,000 in year one, 55,000 in year two, and so on and so forth. So it compounds on itself without ever paying tax. So that is the main reason that capital growth will end up on top. And then on top of that capital growth, so if you do look at just the $50,000 gain, if you were to sell that after 12 months, then you'd also, you pay income tax on your 50,000, but you get a 50% capital gains discount. So compared to rental income, where you would pay full income tax, you're actually only paying half of the income tax, even if you did sell it. So there is a discount there as well. Now, if we look at that, so if we apply 10% capital growth per year for 30 years, that's very clearly not a realistic example, but if we did, then this $500,000 property would then be worth $8.7 million. If we sell it, we pay our capital gains at our 50% discount, then we'll be left with $6.8 million. So let's try and keep that figure in mind for the next slide. So 6.8 was the figure to beat. Now we're going to compare it to what if we took the same property and we said this is going to have a yield of 10% per annum. Now, what happens here? We get 50,000 cash. Instead of 50,000 gross, we've got 50,000 cash, but that is taxable income. Now, if we assume a tax rate of 37%, that means we're going to give the ATO 18,500, and we're going to be left with only 31,500. So instead of our 50,000 in unrealized capital gains, we only have 31,500. When calculating this, firstly, now we've got 531,500. I've still applied a 10% increase to 31,500. I've said you reinvested that into shares, property, whatever it is. So I've still applied that, but because you are paying income tax every year and you're not compounding the full amount, then you would actually only get 3.1 million when you sell this property in 30 years. If you compare the capital growth of 10% to the yield of 10%, then the capital growth will give you more than double what the yield will be. And that's purely because you're paying tax on an ongoing basis. You're not compounding the full gross amount, and we're not getting the capital gains discount at the end. So as you can see, capital growth is clearly superior. Case closed, video done. But if we actually, quick note here, I got another quick note that I added in very recently to this slideshow. The other thing I wanted to talk about on this before we go into the other parts is the certainty of yield and capital growth. So basically, one thing that I think is overlooked with a lot of people is that rental yield comes with a signed contract which will give you certainty. So you might sign a contract which says you get 10% yield, $500 per week for the next 12 months, a signed lease agreement. Now, if you get, that's $26,000 a year. Now, if you get plus or minus, let's say 10% on what you're expected, as in the growth changes in a year, your income goes from $26,000 to plus or minus, 23 or 28,000 total. The change is not actually huge. Whereas if we instead looked at, and we should say capital gains up top, but if we instead looked at capital gains, one, you can't get a contract up front that says this will grow by 10% in the next 12 months. It is always a bit uncertain, despite what some people will tell you. And two, if you apply a plus or 10% margin of uncertainty to that, you actually go from 50,000 gain to 50,000 loss. Now, some people will like that because there is more to gain. Other people will not, but there is definitely a factor of certainty when it comes to focusing on cash flow. All right, next, before we look at some of the advantages or even just the differences of capital growth and yield and see why or when cash flow can make more sense. Quick tutorial on negative gearing. Nothing crazy here, but let's quickly go through it. So if we've got a property and we have $25,000 income per annum, and we've got expenses of $40,000 per annum, we have a net loss of $15,000 per annum. Now, we apply a 37% tax rate as an example, which means we only lose $9,450. I just wanted to point this out firstly because some people will say if you go for capital growth and you've got a negatively geared property, that's an advantage because you get tax back or whatever it is, but it's not quite true because you are still making a loss. You are just losing less money. And likewise, if we compare that to a positively geared property, income of 40 grand, expense of 25 grand, we will get a gain of 15,000 per annum. We'll pay our tax at 37%, and then we will gain 9,450. So again, positive cash flow is always good. Yes, you are going to pay tax on it, but you are still gaining money. Whereas when it's negatively geared, you are losing money. The tax breaks just mean that you are losing less money. So let's keep that in mind. And I think most people do know that, but there's definitely people that do not. So when we, look at that compared to tax rates, because this is the other bit that needs to be thought of, is if you've got a positive cash flow property, so every year it gives you $10,000 in this example, if you are under the tax-free threshold, so maybe you are retired and you don't have another income or unemployed or whatever it is, you gain the full $10,000. Cash flow is very good if you are on a low tax bracket. And that slowly decreases, whereas if you are on a 45% tax bracket, you will only gain $5,500. So cash flow, it is fair to say that those on a lower tax rate will see more of an advantage out of the same property, assuming it's cash flow positive. And if we instead look at a negatively geared property, and this might be why people say those on a high income should look at negatively geared properties. If you compare like properties that loses 10 grand per year, those on the tax-free threshold, they're going to claim a deduction of 10 grand, but they weren't paying tax on that anyway, so they are just losing $10,000. Whereas someone on a top tax bracket will claim a loss of $10,000 and they'll claim $4,500 back on their tax return because that's their effective tax rate. The general gist here is that income and expenses are softened, is the word I would use, for those on a higher tax bracket. The the ebbs and flows of cash flow are not as severe on a higher cash flow because you lose less but you gain less. Whereas those on the lower tax brackets really do want to avoid negative gearing as much as possible, but can see a lot of benefit from positive cash flow. And that's why you'll see later those on a lower tax bracket actually end up benefiting more from those high cash flow, low capital growth type of properties. All right, next let's get an understanding of what I'm actually talking about when I say you got a high yielding property or you got a property focused on capital growth or whatever it is. Let's figure out what those properties are, what they look like, etc. So on here, I have made something. There is no unit of measurement here. This is purely out of my brain. There is some research behind it, but again, no actual scale. So on the left, we have the properties that historically have the best capital growth. Now, I do have a resource somewhere, I believe it's linked on the website, to where I got that, but houses, especially established houses, grow by more than units and townhouses, and probably the other assets, we'll get to them in a second. Now, what they also have is they have the lowest yield as far as these assets go. So you get less cash flow, you get more capital growth. Now, as we go down to the other end of the scale, on the right-hand side, we've got the high-yielding properties, so they have very positive in cash flow. I'm not going to say they are lower in capital gains, because that's not necessarily true. They are riskier properties. We will talk about each of them, but some of them are untested, or some of them, if you look at mining towns as a location, they can outperform a regular property, but they go up and down. So I would say they are high cash flow, riskier properties that are less likely to give you a certain capital growth over the long run. So that's houses. Townhouses and units, perfectly fine. They usually come with slightly better cash flow, but worse capital growth, and that is why people usually avoid them, or investors often do. Duplexes, I have said they are riskier. Whether that's true or not, I don't know. The reason I would say they are riskier is because I cannot find any statistics to back up the long-term capital growth. Now, if they do grow at the same rate as a house, I would say they are always a better asset because they are high-yielding assets. And if you get the same growth, then why would you not go for it? But I've said they're slightly higher risk. You get the cash flow, but you are less certain of its long-term growth. Now, next we got co-living. So co-living, or 1B dwellings. For those that don't know, it's basically like and usually you build these, you can buy them. You put a house on a block of land and you make in there about 5 different bedrooms, but each bedroom is more like a studio apartment. Each one's got a kitchenette, a little lounge, a bedroom, an ensuite, and even a lock on the door. So it's more like 5 apartments in one house. Sometimes they fall under commercial, sometimes residential. But these to me make a lot of sense. I've had a look into these quite a bit, and they make sense as to why people would want to live in them. They return quite high from an investment point of view, as in the yield on them is great. 7% to 12% is what I've got as an estimate. But again, I would consider them riskier because they are a relatively new asset and they don't have the history that houses do. So again, if this is definitely going to grow at or above the rate that a house does, I would say always get this. But I just don't know if that's true. And finally, I've got these as the riskiest property. We got NDIS. So these things return a heck of a lot of rental income, and that's because they're subsidized by the NDIS scheme. I've also said they are the riskiest property because they are subsidized by the NDIS scheme. They cost more to build because they are purpose-built, and if the government removes funding, or you can't get tenants, whatever it is, you have this asset that costs you more to build, and you're not actually getting that extra rental return. So yes, all going well, they're fantastic, but there is definitely, in my opinion, a risk. And finally, up the top there, we got commercial property. I'm not going to go into them too much, but generally they are considered a higher yielding asset than your houses and your townhouses. But they vary so much because you can get very general and safe commercial properties, or you can get very specialized ones which are riskier. So I've put them on a range here, and I'll give some special mentions. So granny flats. So I'm sure you know about them. Your build a house and then you've got some land out back, you build a granny flat for 150 grand, 200 grand, and then you rent out both, and then you get your capital city property from a 3.5% yield to a 6.5% yield. I think they are a fantastic idea, and not only a fantastic idea, I think they are implemented quite well. The reason I don't do them is honestly effort. They are quite a lot of effort to actually get done. And the other thing is overcapitalization. I've definitely seen, you'll spend 200 grand on a granny flat, the value will come back and value it only 120, 150 grand higher than what it was, in which case you have eaten up some of your capital that otherwise could have been used for a different property. But overall, I think they do make a lot of sense. Off the plan, probably, I would say highest risk, high reward. I buy a property now off a developer for 500 grand, and I don't have to pay him that for, let's say, 12 months. That means in 12 months, assuming I can get finance, which is a risk in itself, but assuming I can, then I get to buy a 500 grand asset. I get to pay 500 grand for an asset that's already got 12 months worth of growth, and I haven't paid any holding costs, anything like that. Then I got the full depreciation. So I might pay 500 grand for this 600 grand asset with no holding costs. But they are also the highest risk property, because you might be paying 500 grand for a 400 grand asset. If property values go down, you may not be able to get finance. Perhaps you've lost your job, or perhaps the bank values at 400 grand, or whatever it might be. And construction, new build, that very much similar to houses. The main difference is they do seem to have a lower long-term trend of growth. However, they do come with depreciation, significant depreciation. Now, a lot of the, what do I call these? A lot of the online people selling houses do this, and you buy a house in development and then you claim the depreciation, so you get your tax back and use that to buy the next property. That's not really something I am about. I can understand it in theory, but I think the problem with it is that often the assets just don't perform quite as well in the long run. And I've got here, so interestingly, I made this timeline above myself, and then unsurprisingly, bank deposits line up with it very, very well. So, lowest deposit you can get away with would be on a house at this end of the scale, because it is a safer asset. And up the other end, where you've got NDIS and co-living, you need a much higher deposit, 20% or even more in some cases. So yes, the banks also look at these, and they do consider the risk somewhat in the same way. Next we have got, so that was property types. Now, same little spiel about locations. I'll just try to be fairly quick about it. On the left, we got high capital growth rate areas. Now, this is all historical. Obviously, who knows the future, but all we can do is base it on historical. And on the right, we've got the high yielding, riskier areas. Again, not lower capital growth necessarily, but riskier, and probably over a long period of time, they are lower growth. So at the top, we got capital and major cities. No surprise here, but you got 5.8% growth over the long term. That seems to be a fairly safe average. Any of these resources or any of these figures that you want, go to the website. At the very bottom, there is a link to where I'm pulling these figures from, but I have done my best to give you a genuine figure. But they're going to give you a yield of 2.5–4%, which is, very low in the grand scheme of things. And then we've got regional centers and regional. Now, regional are quite out there and isolated. Regional centers are more like, everything that's going on up the Queensland coast at the moment, Rockhampton, Townsville, Gladstone, all that. I would call them regional centres. The centres seem to generally have slightly better on the capital growth side and slightly worse on the yield side than regional, but I can't actually find a figure. Overall, I can see that regional in general grows at about 4.8%, which is 1% lower than capital cities. But based on what I see, I guess in work every day, the yields, you can definitely get higher than 6%, but most of them come in the 4 to 6% yield range, and probably I'd say more like 4.5 to 6 would be a fair range. And finally, all the way down here, so mining towns. Now, I'm going to talk about mining towns a bit in this because I wanted to compare these to the capital cities. When I say mining towns, I don't always mean mining towns. Other industry and government reliant areas. So basically, it is these areas that are usually very remote, that are very reliant on one or two things. Usually that is the mining industry, which may be one company or one mine or multiple mines or whatever it is. But there are other ones where they're based specifically on government funding, and there are other ones where they're based on different industries, but that's the general type of towns that I mean. Now yields, you can find up to 14%. They're pretty hard to get, but it's not too difficult to get sort of 11% or more. Capital growth can be significant or negative. So these things are known to go up and down. And I've seen somewhere over a 20-year period that actually went down by 0.3% or something. So the risk of these, and that's why they're considered riskier properties, the risk of these is that you don't get any capital growth, or if you don't hold it for long enough, you actually go backwards. And there's even a risk, these things can become absolute ghost towns. If industry packs up and leaves, your property may go down over a very long period of time because nobody lives there anymore. So that's where the risk is, but the benefit is that usually you will get a very high yield and a very high rental income. And again, I got this same little arrow at the bottom of deposits. Again, banks like capital and major cities, regional centres are pretty good. You can get away with low deposits here. Regional, you start to find postcode restrictions, and mining towns, you're very often going to come up with restrictions where you need a 20% deposit or even more. And here we have, these are the same graphs that I just went through. I just wanted to put them together and show you. So I guess the normal way of people doing it, or not normal, but the people that don't spend too much time on it, the regular everyday mom and dad that decide to buy an investment property, they will usually buy a house in a major city. And that is for the most part because, one, it's what everybody does, but two, it is a good, safe asset, and in the long run, it should provide good growth. So it makes sense if you don't want to learn about all this, then I think absolutely a house in a major city makes a lot of sense. Otherwise, houses become quite good overall as an asset. So regional centers, regional mining towns, people will often buy houses regardless, or duplexes. It doesn't really matter. These other assets, so I guess NDIS, I see people buy them in capital cities. I see people buy them in regional centers. I don't see them buy them in mining towns, because when you get the riskiest asset in the riskiest property, yes, you are going to get very significant income from that. If you can make an NDIS property work in a mining town, the rental yield will be massive, but the risk there is going to be huge. So I don't really see that. Usually, people will buy a safe asset in a risky location. Sometimes they'll buy a risky asset in a safe location, but you don't usually see risky. All right, next on my agenda, accessing funds. So again, I just want to make this clear, because a lot of people, you actually want the equity, you want the capital growth, because you use capital growth to access the equity to buy your next property. And that's true to an extent. You can do that, but there's just a lot more to it than that. So if we look at, what do we got here? We got a $1 million property, and then we say it's got a capital growth, 10% capital growth, aka 100,000. Now, if we want to use that for our next property, then firstly, we can access 80% of that, which is $80,000. So of our 100,000 gain, we can access $80,000. Now, the downside to this is, firstly, or most importantly, you need a loan from the bank to access the 80,000. So your affordability on your next property, let's say you need to borrow, you're going to buy for a $500,000 property and you're going to borrow 80%, which is 400,000. If you need to use equity to fund that, then you're going to be borrowing actually 480. So you need better affordability to access that. And moreover than that, it also means you are paying interest on your 80,000. So there is more to access. However, it comes with caveats, which cash flow comes with less caveats. If we take our same example, a $1 million purchase price or property, and we say you get a 10% return, which it doesn't say here, but let's say you get a 10% return of 100 grand. Now, in this case, the cash is going to come into our bank, and then we need to pay tax on it, and then we can use it as a deposit. So if you're on a 30% tax rate bracket, you actually get 70 grand cash. Now, I would always rather have access to $70,000 cash for my next deposit than have access to an $80,000 loan for my next deposit, personally. But as the tax bracket gets higher, all the way up to 45, now you can only access 55. So now to me it's a question, do I want a loan of 80,000? Would I rather that? Or would I rather cash in the bank of 55,000 to use as my next deposit? But yes, there is technically access to more cash from the 10% capital growth, but you must borrow that money, which is important to remember. And here we actually have a side-by-side comparison. So if we do, this isn't quite the example I just gave, but let's say you're going to purchase a $400,000 property next, and we're using our equity for that. We're going to borrow 80,000 from we're not going to cross-collateralize it because we don't do that. We're going to borrow 80,000 against our previous property, which is a 20% deposit, ignoring costs for simplicity. And then we're going to borrow 320 from this property. So we borrow 400,000, which means our annual interest cost is 26,000 when we use equity. If we instead had the 10% cash flow, then what happens is everything's just a little bit nicer. We don't need to borrow from any other properties. We simply put in 80,000 cash, and then we use $320,000 against the purchase property. And yes, the prior one, this one over here, that does come with negative gearing, but again, that's still a loss. Now this cash flow one, we've only got a loan, so we have lower overall debt, lower LVR, lower risk, and we are only paying $20,800 in interest, not $26,000. So the one on the left over here, not only do you have less cash flow for affordability because you bought a property focused on capital growth, but you also then lower your affordability by borrowing an extra $80,000, and thereby your interest is higher. So it kind of compounds, as well as lowering your initial affordability more by getting low cash flow. You're further lowering it by borrowing 100% of your future property. Whereas this one, your affordability stays pretty nice. Here's where things get complicated. So again, I've got a calculator on the website. You are welcome or even encouraged to play around with it. I'll hopefully show you at the end, but feel free to download it, make any adjustments you want, make comments. If you want to make a new version, you can email it to me and I'll upload it onto the website so other people can also have a look. But I'll give you my assumptions going into it, and then I'll show you the results when we compare things. So what we are trying to compare, I put in a control here, 5% yield, 5% capital growth. And I wanted to figure out what happens if we add 1% capital growth on the left, compared to adding 1% yield onto the right. How much money do we actually gain in each instance? So my assumptions, if something grows by 5% per annum, capital growth that is, rental income does not follow that trend. Historically, rental income seems to increase by about 3%. That's a pretty hard figure to honestly nail down, but 3% seems fair. So over time, your yield actually goes down because the capital growth outweighs the rental growth. So I have applied a 3% growth on the rental income. I have factored in expenses so they scale with rental income, and being that rental income is 3%, it's basically scaling with inflation, so that somewhat makes sense. I've used an average interest rate of 6.5%, and I've done interest only for simplicity. But I will note I did try playing around with different interest rates over the long period. It absolutely changed the end result significantly, as in how much money you get in each case, but it did not affect the trends, i.e. it made the similar change in either instance. So the trends stayed the same regardless of the interest rate, but we've just used 6.5 because that's what they are right now. Cash is reinvested at 10% gross per annum. So if you get a property that is cash flow positive, I need some way to justify that, as in, I guess, quantify how good what that money is worth. And I said if we reinvest that at 10% per annum gross, that's fairly easy to get. 10% per annum gross on a 45% tax bracket, that's really only 5.5% net. You could just stick it in an offset and get that for free. You can stick it in shares, or you can buy more property. But all the cash gets reinvested and compounded with everything else at 10% per annum. And negative cash balances, I've done the same. Now this one is kind of hard to wrap your head around, so you might have to trust me. But if you've got a property that gains or loses $0, and you compare it with property that loses $10,000 in a year, I've applied a 10% per annum growth to that 10,000. So I've said instead of losing 10,000 next year, you're going to lose an extra 1,000, i.e. 11,000. And I've done that because that's a missed opportunity of $10,000. The one that didn't lose any money, they could invest 10,000 of their own cash, gain an extra 1,000. Whereas in this case, the one that lost the money can't. So I've just applied a loss to that, which seemed to be the best way to actually, again, quantify things. And then at the end of any period, you'll see what I mean by period soon, but I've said the property is sold, and I've just applied capital gains at 45% because realistically that's what's going to get applied for the most part. On the left, you've got your capital growth, control in the middle, yield on the right. Now, total wealth gain over 5 years, if you add 1% capital growth on compared to 1% yield, capital growth always comes out on top. Now, interestingly, this column over here is compared to growth. If you get a 6% capital growth property instead of 5% capital growth, when you compare the two, your increase is 47% more. So that's not comparing capital growth to yield, that's just pointing out how much 1% capital growth can actually do. And what you've got in each of these rows, these are the different tax brackets. So over a 5-year period, 30% tax applied, 37%, 45% tax applied. So the higher your tax bracket, the more the capital growth performs when compared to cash flow, and that's because cash flow doesn't perform as well on high tax brackets because you pay tax, and capital growth is not so bad because you get a tax discount on any negative gearing. So that all makes sense, falls are trending, but general gist is 1% capital growth is better than 1% yield, according to my personal calculations. And then if we do it over 30 years, what do we notice? Same trends overall. The difference is that the difference increases, as in now at the top tax bracket, it's performed more than twice as well as the 1% yield did, which is, for one, incredible. But this is happening because over a longer period of time, it gets a chance to compound without paying tax more. So capital growth again sort of takes the lead even further. And again, those on a higher tax bracket benefited from the capital growth more so. Cash flow, fairly simple, but we'll look at some numbers, I guess. Basically, the one with 1% yield is infinitely better in all cases because the control loses 6,000. The one with the net 1% extra capital growth loses 6,000. And the one with 1% extra yield only loses 3,000 now. A $3,000 increase compared to a $0 increase over here is infinitely better. But that's not, a good figure to look at. Just look at the actual flat numbers in this case. So let's look at this. Negative 6,000 in this case in year 1 compared to negative 3,000. It's not a big deal, honestly. But in or out of pocket in the first 15 years is an interesting one. To hold this one with the capital growth, so on the control or the capital growth, either way, based on a 5% yield, you need to be out of pocket $85,000 over 15 years, which is fairly significant. You need to be out of pocket less on a higher tax bracket because you get, bigger benefits from the negative gearing. But if you actually had the 1% yield instead, you're not out of pocket. Yes, you will be in the initial years. However, over a 15-year period, you'll actually be $92,000 better off, which means you're not out of pocket. You actually got money in your pocket now of $6,000 to $8,000. And finally, we've got affordability on initial loan. So again, this is something that I think is quite important. When you look for properties that are higher yielding, they provide better affordability. Better affordability means you can buy more property, means you can buy a bigger property, or you can buy your next property sooner. And we're about to try and quantify that very much in a second, but for now, I just want to see what is the difference. And I think this is a rounding error because the trend is a bit strange, but general gist is 1% extra yield in this example, and the very simple affordability calculator that I used, you'll get to borrow 40,000 more. In this one, I did use an actual bank calculator, and you got your max loans here. But I think from memory, I did single, no dependents, 100 grand income. I can't really remember. Here's your gross income. And again, all those figures are on the website if you want to see them. Before I go on here, I just want to show you what this graph is going to be. Basically, I wanted to figure out what are we quantifying if we want to make the same. So if you compare the control of 50,451 to get to 74,454, how much yield would we actually have needed to add on to equate to that? That's what I calculated here. So the value of 1% capital growth, basically if you take any control and you add 1% capital growth on it, it'll gain you $100 or whatever it is. To get the equivalent amount, you would need to add on 1.387% yield in this example. And this graph, what it's showing you is time frame and tax bracket, because they do make a difference. So at the low tax brackets, over a short period of time, so a 5-year period and a 30% tax bracket, for 1% capital growth to actually get the equivalent from yield, you actually only need 1.289% yield by my calcs. So yield is almost as good as capital growth on a low tax bracket and a short period of time. However, over a 30-year period, and on the top tax bracket, that's this green one up here, you can see, for every 1% capital growth that you get, to get the equivalent in cash flow, you would need to be getting 2.237% in yield to get the same net wealth gain. This is ignoring how much money out of pocket you are. This is just at the end of the 30 years, how much wealthier are you once you sell this property? And at the high tax brackets, over a long period of time, you need a lot more yield than you otherwise would. And again, you can use these as benchmarks. How correct they are or not, I would recommend go and have a look at the calculator and do your own calculations. They are not designed to be accurate. I'm making no claims that this is correct in any way, but before I researched this video and did these calcs, I had no idea. I had no benchmark, nothing in my head that told me roughly whether 1% capital growth was worth 3% yield. I didn't know. And that's what I wanted to come out with. And this one I won't go through too much. This is literally the same graph, but inversed. So if you're looking at 1% yield in one example, then this is how much capital growth equivalents to it. So I'll skip past this, but this is on the website. It's just some people will prefer to see it this way than the other way, but it is exactly the same data as that I just went through. So here we wanted to add borrowing capacity in. So yes, you can use that 40 grand extra borrowing capacity for your next property, absolutely. Then you get 40,000 more in your next property. But the simplest way to quantify this was to just say, if we take our control, so our control here in the middle, we've got a $500,000 property. And on the left, we've done the same. We've applied 1% capital growth. Now on the right, we have said that we have equity elsewhere where we can borrow it. So because we've got the yield, we can borrow an extra 40,000 because the bank will let us. So I've actually said that we've got a $540,000 purchase price on a 6% yield. So in both cases, we're going to say we're using our max borrowing capacity. Our max borrowing capacity is just more on the right because I wanted to see how that actually affects things. So let's have a look. All right, so what happens here? Feel free to have a look at this in your own time, but I will just give you some key points. Basically, over a short period of time, sure, on the top tax bracket it's slightly better, but over a short period of time, these things are actually performing almost identically. If you take your max borrowing in both cases, because you've got a bigger asset now, and the same capital growth and a bit more cash flow, then this 1% yield property actually performs just as well. And in the only case so far, it actually performs better if it's over a short period of time on a low tax bracket. So that's quite interesting. Over a 30-year period, again, capital growth always compounds without tax, and therefore it does pull ahead, nowhere near as much as it was in the previous example, but still, over a long period of time, even with borrowing capacity taken into account, I would say you would take 1% capital growth over 1% yield. And the cash flow, the figures are not super substantial, very similar to what we had last time, so I'll skip over that. And then I've redone those graphs, so I believe this should be a bit more accurate than the last one I gave you, so hopefully you didn't spend too much time looking at it. So if we factor in borrowing capacity the best way I could, by just borrowing more money, then we can get a more realistic example of how yield and capital growth compare. So for the first time again, if you had a 30% tax bracket and you are doing it over a 5-year time period, you may actually perform better with the 1% yield instead of the 1% capital growth. The yield is actually now more worthwhile than capital growth, I believe. And then as we get over a long period of time in a higher tax bracket, capital growth once again pulls ahead, but still not as much as it was. Now you need 1.5 yield to get the equivalent wealth gain as 1% yield. And the other thing to keep in mind with these graphs is, again, they are based purely on wealth gain. So if all else was the same, if I was offered a property that gave me either 1% extra capital growth or 1.5% yield, and if this was me, I would always take the yield because the wealth gain should be very similar, but I get extra cash flow, in my mind, a bit of extra security if assuming the property is going to perform as expected, and everything is just a bit nicer. You don't have to put money into it each year. So next one, again, complete opposite of the other one, same details. Go have a look at the website if you want it. And then this is my final one before I wrap up. So this one I wanted to actually put it into a real life scenario. So 1% capital growth, 1% yield. It's not very useful. It's not very real. It was more I wanted to get the numbers out. So I wanted to give you my best examples or best guesses at real life example of what's going to outperform what. So we've got a capital city. We found our long-term average of 5.8%. All of these have a rental growth of 3% applied. Rightly or wrongly, we don't know. And then the yield in the capital city is 3.5, which is probably fine. You can get lower, you can get higher, but that's probably a good example. We've got a regional property, which you could definitely get with a 5.5% yield. Long-term average growth is 4.8%. Now, some people are going to be, but what about the capital growth of 7 and 8% that we get in the short term? This is not meant to look into that. If you want to go for these regional hotspots and you're confident you're going to get 10% capital growth over the next year, obviously that is going to outperform everything. There is many risks that come with that, but if you knew you were getting high capital growth, then yes, that would be better. This is more about the long-term trends and using, I guess, sensible numbers. Up to you how you want to do your own portfolio, but I very much like to focus on the long term more than anything else for my own. And on the right, we have a mining town. Now, I actually think I could have gone higher yield here than 9%, but I've gone 9% because that's definitely achievable. I've gone 2% capital growth. Now, this is the problem with this example because, as I said, you might get 0% capital growth. But I think over a period of time, assuming you know the industry and assuming that you are correct, because that you have to be if you want to do this. Assuming you are correct, let's just say all you care about is that there is just slight capital growth. It doesn't even have to keep up with the market, not even inflation. It just doesn't go backwards, it grows a little bit. If you are confident in that, then let's have a look at what the figures actually come out with. Alrighty, so left is capital city, middle is regional, right is mining town. What happens? So regional property comes out very good in a lot of cases. So wherever the black arrow goes in, that basically means that the overall the regional property is outperforming compared to the outer one. So in this case, in the short term, 5-year period, at all tax brackets, based on these figures, the regional property will outperform the capital city. And interestingly, the mining town, over a short period of time in a low tax bracket, the yield is actually better than that of either of the others. You actually end up with 58,000 in net gain as opposed to 55 or 41. So again, short periods and low tax rates, cash flow is good. But overall, regional is really performing quite well over 30 years. So firstly, the capital city, because of this compounding effect, now starts to actually outperform the regional. Not by a huge margin, honestly, but it does. Instead of your 1.288 million, you get 1.3 million, so it outperforms slightly. And interestingly, our mining town actually performs really well on the two bottom tax brackets, which is really interesting to see. And then cash flow, obviously this 9% yield is going to be much better, but again, let's look at the flat figures. So if you bought this capital city, you're going to be out of pocket 11 grand a year. Regional for 4.8 grand, whereas the mining town you're actually going to be 5.8 grand in the black, which is quite nice. In/out of pocket, again, super significant. The regional one stays fairly neutral, negative a bit. Capital city, you've got negative 200 grand out of pocket in 15 years. It's quite a lot. And you'll actually be, you'll gain cash of 280 or whatever it is, depending on your tax bracket, if you get this mining town property. And then affordability. I haven't factored affordability into this. These are all 500 grand worth of real estate, but we can have a look. Max loans going from capital city to Regional, it's about an 80 grand difference. Again, depends on the tax bracket. And then going from regional to the high yielding mining town, you've got another 100 grand or even more there. Overall, I would say regional, and this is presumably what other people have figured out themselves. This is probably why lots of people are buying regional properties right now. They do seem pretty solid in most instances. If you can get a solid regional property, it seems like it will perform well in a lot of scenarios, and I think that is why people have it as their backbone, often as of their portfolio. But again, if you're actually on a high tax bracket and holding this for a long time, just buying just capital growth is really all you need to be focusing on, I think. And these cash flow ones, I find them super interesting. I think, if you can find one, if you know this town and you're confident, if this is going to get even 5% capital growth and give you 9% yield, that's going to outperform everything, certainly. But again, they come with a lot of risk because they might go down, or presumably at some point probably will go down. But if your risk appetite is very high and you are on a low tax bracket, then absolutely you might get significantly more gains by taking those if all goes well. I'm not going to read all this out, but I'll go through the key points and you can have a read later if you'd like to. But on the left, we got high yielding properties, pros, and on the right, we got pros of high capital growth properties. So for the most part, the only pro of a high capital growth property, in my opinion, is that in a lot of cases, you gain more wealth. And again, it depends how much we're comparing, but for the most part, capital gains does result in better wealth growth. But high yielding properties, one, they give you more cash flow. So even though you've got riskier properties, I think people need to also consider that, in my mind, there is less of a risk in some ways because you have the option to hold these things. So if I lose my job and I've got a property in Brisbane and it costs me 15 grand a year, I probably can't hold that property and I might take a loss. I might have to sell it, take a loss of for the stamp duty early and not get those gains. So whereas if I have a property out in a mining town, even if I lose my job, I can hold that property. I can hold that property for 20, 30 years until it eventually makes the gain, probably or hopefully. So there is definitely the ability to hold it, which I think is important. And that's risk. So I've actually said risk. This is actually back to front. This shouldn't be read like this. But I have said that overall, I think the high capital growth properties, I would say they are less risky because from a long-term point of view, they'll give you more guaranteed wealth gain. But do consider that there are advantages to having a signed lease agreement that guarantees you this much income. And that if you lose your job, you can hold that property. There is some merit to that, I think. Next, affordability. Obviously, high yielding properties, we've had a look at how much, definitely helps. Access to funds, much easier. Instead of borrowing for your next property, you're going to have the cash, which is really nice. And thereby, I've said your ability to grow a portfolio on the high yielding properties, you will buy more properties overall because you can borrow more, you have access to cash, and it's overall a lot nicer now. You've got to make your own decision. Do you want 5 properties that are high risk and returning 10% per annum, or would you rather 2 properties you can hold 30 years with very solid and high capital growth? That's the sort of thing that's up to you. But if we're talking purely numbers, you should be able to own more property when you have high yielding properties. And then finally, synergies with trust and company borrowers. I'm not going to go into that much here because I have a whole another video on it. But getting these high cash flow properties, again, that can help a lot when you are buying in trusts because 1, negative gearing doesn't work properly within trusts. And 2, if you're doing it from and you want to buy more properties and you need additional affordability, it's very beneficial if it's in a trust and it's cash flow positive. So yeah, the first one is probably the biggest thing that I came in, and there's no shock, but the biggest thing I actually took away from this is whatever has the best stats is going to be performing. I compared 1% capital growth and 1% yield, but really the big winner was you add 1% yield or 1% capital growth onto anything. If your property just performs 1% better than these others, and 1% is disingenuous there, but slightly better than the other properties, you will get like 30 to 50% more gains. So whatever you're focusing on, a good property will help a lot, I believe. All tested properties appear viable over the long run. So we're up to here. I believe that they all made money. Even, and I haven't done the figures, so do the figures yourself before you consider this. Even if you get 0% growth over 20 years, if you've got your 20% cash growth, your 12% yield, you're probably okay. Maybe not as good as elsewhere, but you might be all right. I don't know. Risk was a major factor. So high risk properties, better cash flow, super nice, lots of advantages in my opinion, and can work out very well for you. But again, risk on how the property performs, and comparing them side by side. So obviously you need to take everything into account in all cases, but comparing things side by side, those on a higher tax bracket, they get more advantages and more gains for these properties that are focused on capital growth, and they don't need to care so much about cash flow. Whereas those that are on a low tax bracket, they don't gain as much from the capital growth when you compare it to the cash flow. So I think there is definitely reason to look at more cash flow if you are on a lower tax bracket. And you can, there's other things you can do. You can, if you've got a bunch of properties and or are self-employed with the right setup, you might be able to put a bucket company and cap your tax rate to 30%, even if you're on a high income, and then you can get more advantages from the cash flow. But that's, again, for another time. And regional properties appear to be an excellent mid-ground for all investors. So I really do believe that. And again, it makes sense. I see everyone buying it. I've kind of done the math myself, and now I can see why, assuming they came to the same conclusion. But I will also add something, and I'm probably about to talk out of my arse, so take this absolutely with a grain of salt. I am starting to think some of these hotspots, if you want to call them that, are riskier than people think, because people are buying in these regional centres because they think it's going to be a long-term hold and they're going to get good capital growth, and that might be true. But I've seen quite a lot of valuations lately where they come in under and or come with a high risk marker, which basically said buyers agents have come in and pumped the price up by 25% in the last 6 months. Now, if you buy at the start of the 6 months, you can even sell in 6 months and you'll make quite a lot of money. But if you are buying for a long-term hold and you buy it when it's already been inflated, maybe over a long enough period, like 30 years, it will still perform well. Maybe it won't. We just haven't really, buyers agents, I'm not going to say they're new, but to Australia, they're definitely more significant now than they were by a long shot. And they are having a huge impact on these markets. And I just haven't seen the long-term effects of this yet. So I am a little cautious. And the other thing is, a lot of them are very, very successful because hotspots are self-fulfilling. If you get all the buyers agents and they all say Gladstone is going to be the next hotspot, for example, it doesn't matter about the fundamentals of this place. It doesn't matter whether the real estate market's going to grow, because it's going to go up because the buyers agents think it's going to go up. And so what will happen is you'll buy a property, assuming you're, in the first few waves, your property will go up by 10, 20% in a year. And then the buyer's agent will come and they'll show you how clever they are and they made you all this money, and then you'll do it again. And it just keeps rinsing and repeating on these self-fulfilling prophecies. But yes, if you get that gain and then it performs well in the long run, I think these are fantastic. And that absolutely may be the case. But if they are overinflated and they perform poorly over the long run for these short-term gains, I don't know if they are worth it. So I am cautious. I absolutely do buy in, regional centres, but everyone can make up their own mind. Final points. Everything is available on the website. I've said that so many times, but it is. I might even give you a quick look in a second, and the calculator, I'll show you that too. Act on this information at your own risk. As I've said, I've no idea if this is correct. Have a look at the assumptions, have a look at the calculator, play around. If you see a mistake, by all means, let me know and I'll correct this video. I don't believe there are any, but make your own decisions. This was more of I spent a lot of time into it and I'd rather share it. And then finally, please do like and subscribe. For the most part, honestly, if I can actually see that people do care about this stuff, it will incentivize me more to make more of these, because honestly, I don't know if you can imagine how much time this actually took to research, calculate, and then create. All right, website. Let me give you a quick look. So firstly, here is everything as promised. feel free. There are some references down the bottom. There are plenty of figures that you can refer back to if you want to. And here, so under where the video is going to be, there is an Excel and you can download it here. When you do download it, it looks a little bit like this. I am not going to go through all the calculations. If you are Excel savvy, feel free to read through them and you'll see what I am doing. But on the front page, so this section and this section are identical. They are just so you can compare two things at the start. By all means, please have a read of this. This is probably quite important. And then otherwise, just have a look at these notes. I put notes all through these and through these. It'll explain what each bit is. And this will explain, in a lot of cases, my justification for doing it this way. And also what it's doing in the back end, so you can play around with it. And as I said, if you think you can do it better, please do so. I will put it up next to mine on the website. Obviously, you need to email it to me and I'll need to review it. It needs to be fairly friendly for other people and it needs to make sense to me. But if you think you can make it more accurate, or you want to just give people a different opinion, maybe you can stick some graphs up, much like I did underneath. Whatever you want to do. If it's good, I will happily put it there. If you want credit, ask for credit up the top. Final point, just to make it clear, because a lot of people do get confused sometimes. I am a mortgage broker. I am not an accountant. Don't know the first thing about tax, technically. I like to think I do, but no, I can't give you any advice on any of that, nor am I a solicitor. I am a mortgage broker. If you are looking to buy an investment, if you want to structure it, I guess correctly, please do consider talking to me. A lot of the time we are quite busy, and I guess the new customers, unless you have a signed contract, all the existing customers get precedence. So, you know, once we're ready for an application, we will do everything pretty quickly and pretty consistently. On top of that, we have people who will track your application and everything should be quite smooth. But the initial review after you have a chat to me, if you want an hour-long video call, usually I need to collect your information up front. So I collect your fact find and your pay slips or whatever it is. And that can take me, I'm going to say 2 to 5 days in a lot of cases to actually review, make a file, and then I'll give you a link to book in and we can have an hour or even 2-hour chat about what you want to do. Can't tell you what property you should buy. One, because I don't have a clue, but I am more than happy to, I guess you can bounce your ideas off me and I'll try and poke holes in them if it seems to not make sense. Cool. If anyone has actually watched this far, then I appreciate it.